In Sherwood stood a yeoman bold, his arrow flew for good. He took from lords their stolen gold and fed the greenwood. Now comes a Robin sleek and tall, who liveth in thy land. He taketh from the small of all and giveth to the grand. He crieth free, and free it seems till thou hast read the scroll. Thy purse is sold to sharper men who sup upon the flow. He showers thee with paper flowers for every foolish trade. The house doth win, the merry din is how the sheriff's paid. So mark the tale, ye merry men, the mark is thee. Come sit ye down and hear us now, we're talking real money.
Well, we heard the minstrel theme is very popular with our listeners, and today's minstrel theme, well, I bet if you listen to it carefully, and if you didn't, just hit that 30-second or 15-second back button on your player and go back and listen to the song again. I bet after you listen to the song, you know what we're going to talk about today, because it's themed to the topic. Themed to the topic. Yes, we're going to talk about Vlad and his merry band of thieves, also known as Robinhood. Vlad the Money Impaler.
That's not
and he's
far
managing
off,
to
actually.
impale some serious. I mean, I think the last quarter they made $100 million or something.
And this is why it's topical today, right? Because you've heard, I've gotten kind of huffy with
You
Robinhood.
are just furious with Robinhood.
Yeah.
This is as hot as I've ever seen you. He's
Angrier
not an
than that.
emotional person, people.
I know. Yeah. Well, anyway, here's why. Here's why it just gets back in my face again.
It sticks in your craw.
Literally. Robinhood saw its transaction revenue from, and I love this, event-based contracts, is what they call it. Event-based contracts.
Uh-huh.
Let's say what that really is. Games.
Gambling.
Yeah. They're betting.
Pure gambling.
And
Pure gambling. It's not even...
these
it's
are
not even
things like
hidden.
who's going to punt first and who's going to get the first. I mean, you can do all these prop bets. $156 million in the second quarter of this year. That's up over $50 million from the prior quarter and from practically nothing a year ago. So these are the prediction markets that they're making it easier for you to gamble on. I'm not going to say invest. They're going to say invest.
Yeah, they're going to say invest. As a matter of fact, I'll tell you what we're going to do. There was an interview done by Bloomberg Podcasts like 3 weeks ago. And let's let Vlad, the Money Impaler, explain, Vlad Tenev, who's the CEO, explain their business model right now. Listen.
Robinhood has begun to diversify, and that's accelerated over time. We now have 13 business lines generating over $100 million in annualized revenue. Their goal is to make their businesses as big as possible and win in market share across each of these. So our goal is to be number one in all categories that we offer products to customers. Those customers bring more assets onto the platform, and they become gold subscribers. They use more of our products, which gives them an opportunity to deploy their assets across all sorts of different areas. Retirement, they can spend with our card products, they can earn a high rate, including on our FDIC insured deposit sweep. Also our Robinhood Earn crypto-backed product, which offers 7% APY. That's been growing really quickly. So we have all of these things that we enable you to put your money to work, and then those in turn bring in more customers. And now we also have advisors. So we have advisors joining the network. You can get a human advisor on Robinhood to help give you even more personalized guidance.
Now, there was some interesting stuff in there. The 13 business divisions, all of which kind of operate independently, and you can hear it between the lines. They fight with each other to dominate their area. And of course, one of those 13 is prediction markets. One of those 13 is crypto.
Yeah. How about options contracts?
Options, stock trading, all of these dangerous things. But Tom, The real interesting part of that whole explanation came right there at the end when Vlad alluded to registered investment advisors at Robinhood. Now, we talk about registered investment advisors a lot. And registered investment advisors are required by the Securities and Exchange Commission to act in your best interests. Wow.
So what are they putting them into if you're an RIA at Robinhood?
Well, here's what my understanding is from looking at their Form ADV. They claim they're siloing it, that they don't recommend their speculative business divisions to those people. But think of it this way. Let's say your registered investment advisor had an office on the Las Vegas Strip, but it was a very, it was a conservative business office where you came in there and you did stuff and, you did your transactions, you had your well-diversified portfolio, and yet right there in the waiting area of the office is this glittering door, giant door with lights over it. Win big, make millions, free drinks, free food, free everything you ever wanted, all your dreams come true through these doors. And the advisor's going, I can't tell you to go through the door, but if you'd like, I can open it for you.
Yeah, the door to the casino is right there. And this is my objection to the entire thing, frankly, that they hold themselves out as a custodian. You don't hear them advertise much their RIA practice. I guess that makes me happy. They have all these gimmicks all the time. They still have the 3% unlimited match promotion on retirement account transfers and 401k rollovers. So if you want to give them your
that's
IRA,
a lot of money, by the way.
It is a lot of money, and that's unlimited, people. For those of you who really, can't you just go to Tulalip or Muckleshoot or do something? But no, you can't.
That's for our friends in Washington. The rest of the country has no idea what Tulalip or Muckleshoot are.
And they're not going to know those.
Tom
Native
is so
American
used to
names.
doing a radio show in Seattle that let's
All
say
our clients last week were like,
Bellagio.
"Where have you been?" Yeah, we just
or
got together. And they were
Harrah's
like,
or
yeah, okay, thank you. Something that's
MGM.
So I took
Hard Rock.
took time to go back and read some of the reviews. People on both sides, the people that like Robinhood, the sort of gamification, the excitement of investing, and the people that like the promotions, and the people that are a little hard on them. There was one guy, a financial commentator, who said prediction markets are now 20% of everything Robinhood earns from trading. A year ago, it was 2%. I love this. My optimistic read is these people come for speculation and stay for the investing. Yeah, right.
No, they come for speculation and stay for the gambling.
My worry, he said, is that for a substantial portion of the user base, it never happens, and Robinhood is simply very good at monetizing speculation.
Yep. I
think they're very
totally
good
agree
at
with
it.
that. I
Yeah.
think they are very good at making a lot of money off people's greed, and belief that we are smarter than we are and that the future is somehow predictable. Look at the amount of money lost in this country every day gambling. I mean, it's billions and billions of dollars with the hope that they're going to win big, when the all of the data has to point to you're going to lose. You're going to lose. Almost all of you are going to lose. A few will win. You will lose.
Yeah, and the thing, beyond the gamification, which I think is horrible, it looks like a game of some kind when you go there, but they make it easy for people that know nothing to get approved for high-risk trading strategies, options, margin trading. There was the tragic case of the young man who thought he lost all that money and took his own life a few years ago. And then beyond that, as a company, they've been investigated for this. I don't know where it stands today, but the payment for order flow, who they send the trades to, and what they're actually making for handing your trade to somebody else.
Yeah, notice that was one of the verses in the song.
Yes, it
Thy
was.
purse is sold to sharper men who sup upon the flow.
You're so good. And you're right. We should all go back and listen to that a few more times. I guess at the end of the day, the reason I don't think you should use them is you don't need them. If you're going to use them as a custodian, who would you rather use? Somebody like this or somebody a little more conservative like a Schwab or Fidelity, which we've criticized in
Schwab.
the past?
Actually, if I was going to rank them, I'd say Schwab or Vanguard.
Yeah, okay.
Because Fidelity still plays these silly commission games with their funds. I mean, they're up there, but I wish they'd just give up on this. They can't give up. They're so addicted to that revenue.
They are. Yeah.
Like Robinhood is going to become even increasingly addicted to prediction market revenue. This is what they're going to push. It's the most profitable thing they have. You
Yeah,
think they're
and
going to
it's
push
big.
their RIA responsible business? No.
No. And do you want to hire someone because of a gimmick when it comes to your financial services? I don't think so. I mean, maybe your cell phone, but I don't think when you're talking about your money, you should be doing that. And then the other part is, do you want to sell somebody? You said it so well. The analogy is so good that where they might be dressed in the three-piece suit, but at the same time opening the door to the smoky casino floor where you could
Not
really
smoky.
make the big
It's the air's clean now and it's
the
sparkly.
I think
but
there
it's
still are casinos where you can go smoke in Las Vegas.
Yeah, but most of them are smoke free, which is good for our health, but bad
Sad
for our
day.
wealth.
Sad day where you can't
Because
go
now you're going to want to hang out longer because you're not choking to death.
Exactly. So that's why this will be something, by the way, that we continue to watch because it's so popular with people under the age of 35 or 40. It's big, right? That's where that money is going. And I'm going to try to stop you because I think it's going to be harmful in the long term to your financial health. I'll put it that way.
This is literally the most dangerous thing you can do with your money. Really. And, if you don't want to invest that money, you don't want to grow that money, your goal is to have fun. A lot of people say, well, it's just fun. Well, spend it on a nice vacation like Tom. Tom can tell you a lot of great places to go. He's good at vacationing. Actually, his wife is better at vacationing.
She's very
But they're good at vacationing. I, on the other hand, pretty much suck at vacationing. I get talked into a cruise once in a while, and then I'm green around the gills, and I don't know why I do it. I fly 15 hours to New Zealand, and I have fun, and my wife is not happy. I give up. I'm not vacationing anymore. I'm just going to write songs.
You're doing that well, too.
Did you notice also one of the verses was, he showers thee with paper flowers for every foolish trade? That's the confetti.
I know. And they do that well, like I do vacations well.
They do that well. So the other thing we do, or try to do every episode, and we continue to do because you are very responsive, is answer your questions. You can send them in at talkingrealmoney.com, clicking the button that says Ask a Question, and then one of two things happens to those questions. Either Tom goes, oh, this is a good one. I want to have a talk with this person. And he picks up his phone and he calls you and records it. And then I make it sound even better and put it on the show like this.
Hey, thanks, Don. And we're very happy to have a regular number of callers / listeners / questioners. And one of those is Andy, who joins us from Zanesville, Ohio. Not Zanyville, because that'd be more fun, but that'd be too crazy maybe. Anyway, all kidding aside, thank you for being on the program. And how can we help you today?
Well, I appreciate you calling me Tom. I love listening to your show every day on the radio. I listen to several financial podcasts, but yours and Don's are the one I listen to most regularly. I never miss one. So
Wait, there's other financial podcasts? Oh my God, I didn't know that. Okay, well, I'll take that up with the powers that be and see what I can do about it. So, but thank you for your kind comment. All right, enough joking around. What do you want to know today, sir?
So my question is, I'm about 4 years from retirement. Now, whether or not I fully retire at 65, we'll see, but I want to have that option at least. So I'm looking at the withdrawal strategy, and I like your flexible 5% withdrawal strategy that you guys talk about. However, I guess I'm thinking to myself, if there's a market correction and say it goes down 30%, if I save on a $1.8 million portfolio, that's 5% would be $90,000 a year. So if you have a 30% decrease, now you're down to $65,000 a year that I'd be pulling out to live on. To me, that's a pretty significant decrease. My thought is, well, isn't that the purpose of having the bond portion of your portfolio, so you could just withdraw from that and just let the stocks recover, and then you don't have to adjust your spending as much?
Yeah, it's a great question, by the way. So, and to what is your current stock to bond ratio?
Right now, it's about 75-25.
Okay.
But it should be 70-30. So.
Okay, so at a 70-30, a 30% decline would be pretty precipitous because you could have a 30% decline in stock, certainly, but not it'd be very unusual to have one that sharp in a 70% stock, 30% bond portfolio. So that would be pretty significant. So, but back to your question, like, well, yeah, you're right, 5% flexible, but I still have all these fixed income that I can draw on. You're exactly right. First, and I want to mention one thing because this comes up a lot, and this is the reason that we really suggest anybody certainly within 5 years, maybe within 10 years of retirement, has a plan, because every plan is idiosyncratic, right? Mine's different than yours different than mine. I mean, my wife took Social Security a little earlier. I'm waiting until I'm 70. I mean, there's a whole bunch of factors that range into all these things, the fixed income sources plus the portfolio, et cetera. So there really isn't one set way. And you mentioned the 5% flexible. We also talk about a 4% fixed. The 5% flexible works better for the long haul, obviously, because you're just taking out 5% of the portfolio amount. But as you correctly point out, that could be a whole lot less in some of the down years, and that would be painful. The purpose behind it is just to kind of show you in a general sense how it works out with different strategies under different market conditions. That's it. There isn't right or wrong. And you're exactly right. You could pull from the bonds and wait for the stocks to go back up. And if you're properly diversified, that could be pretty quickly. And if recent history is anything, I mean, 2022 and 2020, the market rebounded pretty quickly. So yeah, you're right. We just show you the 5% flexible as a potential strategy. When we work with people, we sit down and it's a year by year kind of gambit, right? Because you really want to know, well, how's it look next year? How's it look the next year? And in fact, we run it 1,000 times, in the projections just to see kind of every market condition. I like the fact that you're thinking about it with 4 years left. I don't want you to worry too much about it because if you're a regular saver and you're properly invested, you're doing everything you can to pull for that. I would urge you to probably have a professional look over your shoulder to make sure you're kind of doing everything you can today and that you're headed the right way. But I wouldn't fret about whether it's 5% or 4% or 6%. I think it was Christine Benz from Morningstar who once said, the only withdrawal rate we'll know was correct is after you're gone. Because, my parents, for example, they didn't spend all their money. They left some to us. I used some for my business. I mean, other people did other things, but there was no, kind of end up with zero portfolio design. So, never really know. But your thinking is right. And by the way, it's just overlooked, I think. That's why you have fixed income. Fixed income, for example, because I just did some research on this from 2000 through 2009, where the S&P 500 lost money. A diversified portfolio, by the way, made about 6.5% a year. But fixed income made about 3.5% a year during those tough times. So if you're just in the S&P and you're losing money over the long haul there in that decade, at least the bonds were holding steady and giving you some return. So you're right. You could be pulling from that, waiting for those stocks to return. So your strategy is right. So your question is actually, absolutely correct. You could pull from the bonds. I guess my suggestion to anybody is the 4% fixed, the 5% flexible. Those are just designed to kind of show you what it would look like through good times, bad times, et cetera. But there really isn't one that's set for you, because your retirement is about your situation, not about some example that we're showing you.
Yeah, and realistically, I'm hoping to hold off on Social Security till 70, so it'd really only be for 5 years or so, and then
Right.
years to kick in. And,
Yeah, and I do, by the way, and I do urge people in their early 70s, especially if they don't retire till 70, to go do the things they want to do. Because the number of people that we run into that get into their late 70s that don't want to travel to Europe, they don't want to do things that are physically more demanding. So I would be telling you, if you are our client, go spend your money, go enjoy it, because we don't know how much longer our lives are going to be, and you want to get out and do it. So, but yeah, you're right.
That's good.
Exactly. So yeah, but you're correct. The bonds are there for that purpose. I give you another example. If you had $1 million in a portfolio, say, and 60% stocks, 40% bonds, that means you have $400,000 in bonds. You could pull on that generally for a long period of time while you're waiting for stocks to recover, should they go down sharply at the beginning of retirement. So, Andy, I think your planning sounds good. You're thinking exactly right, and keep working on it. I think you're gonna have a great retirement ahead of you.
Great, I appreciate it.
Thanks for sending your question, and thanks for being a listener.
So there's that. There's the recorded call, which we love, and then there's the another meme for our show, the dead tree killing segment. Tom
taking
kills
on a life
trees.
of its own. Yeah,
took on a life of its own, like the Model Military Aircraft Museum.
For a time. That's
For a
out
time.
now.
Everything has its
true.
time
Turn,
and its
turn,
place.
turn.
Now,
That's good.
now
Yeah.
Tom's going to take his dead tree questions and read us a couple.
From Taylor's, South Carolina, Shelley says, I'm 59 and a half and I'm retired. In the process of transferring my retirement funds to a target date fund at Vanguard. I have about $1 million, not including my paid off home of $415,000. 25% of the $1 million is in a 5-year CD ladder. 2% in high yield savings account. The remainder in the market previously with an advisor. No debt. My intention to take Social Security at 70, which is a long time from 59 and a half, which will be an estimated $3,000. I consider the $250 in the CD ladder as my safe fund. I think that's reasonable. Question. I am considering enrolling in the Target Date Fund 2035, which consists of 46% of total funds, and the remaining amount Roth in the 2040. Risk tolerance on your site 51, tolerance group number 3. Please evaluate the above. I look forward to hearing your response on the podcast. So, okay, question. So remember, if you have $1 million and you have a quarter of it in a CD ladder, that's already 25%.
Right, that's 25% of your portfolio fixed income already.
Yeah, so then if you go with the 2035, which I'm betting is 60% in stocks, 40% in bonds. That's just my guess.
I'm going to check.
Looking it up right now. Vanguard 2035.
2035 is a... No. No, it's a 66.
Okay, so a little more. But still, then you throw that 250 back in, then you are getting closer to your risk tolerance score of 50, right? Because you've added the money in the CD with the target date fund. So, yeah, I think you're kind of meeting where you are.
Yeah, because 2040 is just like closer to 70.
Yeah, so which is where your Roth should be, because you should have more risk.
You're right.
So
right.
I'm good with this whole thing. What's your take?
I think it sounds great. No, I think it's great. It's cheap. My gosh, these funds are cheap.
What are they getting now for the target?
8/100ths of 1%.
That's crazy.
8/100ths of 1%.
They must have closed the old Bogle cafeteria.
I mean, that is so cheap. So yeah, this is a really good idea. I like it.
Yeah, Shelley, keep it up. Jay from St. Petersburg, Florida. Hi. An elderly relative was talking about REITs, real estate investment trusts, such as AGNC and ARR. I wonder how you compare them to VNQ and others. They have a significantly higher dividend. Can you analyze the risk aspect of them and provide your opinion? I think he's providing his opinion right about now.
Oh, my God. Let's start with the Armor Residential REIT, okay? This is a specific REIT. You see, the Vanguard REIT Fund is a fund of funds.
Yeah, it has many REITs inside
Many
of it.
REITs.
Yes.
In fact, it has all of the REITs. Basically, they try, and all of the publicly traded REITs are in there. I believe it's the whole market. The VRR pays a much higher dividend. It pays a dividend of
How much?
17.5%.
Excuse me?
17.5%. Do you want to know how?
I'm just speechless. I don't know where
Do you want
that
to know
would
how?
come from.
Well,
they're giving you somebody else's money or
let's
something.
go back in time, shall we? Let's go back to 2009. Back in 2009, ARR traded for $395 a share, paying that big honking dividend. 2009.
Yeah, okay.
Okay, 2019, it traded for $101 a share.
So it took a bit of a hit.
Oh, yeah, 1/4 of its value. Wait,
Okay.
fast forward, 2026. Today, when we recorded this in August of 2026, $16.32.
I can't run that number, but it's not good. I'll put it that way.
Well, it's like 1/8. So the thing has gone from $400 to $16, $17.
So $40.
Yet you collected a really nice dividend along the way.
Right?
That was just your money coming back to you.
Yeah. This is
No,
not something
both
we
of these,
recommend.
both of the REITs you're talking about are paying ridiculously high dividends. What was the other one symbol? I forgot.
AGNC. And while you're looking that up, VNQ is the Vanguard REIT fund, which you get at 13 basis points, diversified, low cost. And so if you want to own REITs, I think that's a good way to own them. These are individual REITs, these other two that are traded publicly.
Yeah, the ARR is buying actual real estate. AGNC is buying mortgage notes. They're just buying government-backed mortgages.
Sure.
Yeah, and here's the problem. They're paying 13. What is the rate on mortgages right now? 6.5?
6.5, 6 and
So if they're paying
2/3.
13 and the securities they're buying are yielding 6,
somebody's really not being nice to you.
no, they're just giving you your money back. And let's just look at that long-term chart for AGNC. Let's go back to 2012. Its high was 33.
Yep.
Now this one's not as bad because it's not individual real estate; it's mortgages. But 33 in 2012. 14 years later, $10.70.
So a third. Yeah.
Yeah.
Lost 2/3.
Your money is coming back to you.
Yeah. No, these are not
idea.
good products, and tell your elderly relative not to use them. All right. Lance writes us from Blanco, Texas. Can't express how much I enjoy and have benefited from your show. I only wish I'd found it sooner. Me too, Lance. My question is one I hear kicked around frequently. It's a topic my wife and I have probably overthought to death. Our 3 children have delivered my wife 7. Wait. I don't understand the 7. Oh, is it 7 children, and they have 4 grandchildren over the last couple of years. Okay.
Yeah, all right.
Given the fact that we've been very blessed, fortunate, lucky, I agree, in regard to our finances, off the record, so I guess I'm not supposed to say. We'd be
It's off the record, Tom.
Well, they wrote
What kind of
it.
reporter are you?
He said off the record and then put the amount. We'd like to begin gifting. $10,000 birth gift and $1,000 for Christmas, $1,000 for a birthday each year. I want to be your relative. That's really nice. Trying
Just
to
take
figure out
one
the best way
fewer vacations and you got that.
trying to figure out the best way to do this. Looked at the UGMA 529s.
Yeah.
Uniform transfer to minors, uniform gift to minors, 529. Don't like the restrictions on those options. So, considering others, number 1, open a series of sub-tiered accounts through our financial advisor.
Okay. Well, one, that's not a gift. That's you keeping the money earmarked for them, but it's not a gift yet.
And you could take it back anytime, right?
You can take it back anytime. Yeah.
Sure. This kid makes you mad. Allow the advisor to manage the accounts until the time we and the parents like to see the cash distributed. Advisor would apply the fee to the sub-accounts at the current asset rate at 50 basis points. Number
Very
2,
fair.
open a series of accounts in our names with Fidelity or Vanguard and use the same contribution cadence using target date mutual funds. As I said, I feel We've overthought which of these two options we should move forward with, and if you're thinking we're off track by accepting the tax consequences instead of choosing one of these options, you have a better solution, we'd love to hear it.
No, there aren't any. There are two options. One, you can give it in one way, shape, manner, or form to them through UTMA, UGMA accounts. That's a true gift, but by law, it has to become, if it's a gift, it has to become their property at the age of majority. Okay.
That's it.
That's the downside. The other is the 529 or similar types of accounts where you still maintain control. You do. As
It's
the donor,
your account.
it's your account. You own the account, but there are big benefits potentially for the kids for education. And it's not just college. This could be trade schools. This can be certifications. This can be all kinds of stuff. So I might do a combination. I understand you want to maintain control. You already have an advisor. Your advisor's charging a very fair fee. I think I might go with that because your advisor can build something that's very appropriate and specific for part of it. But part of it, I think I do a 529.
Remember, the 529 is not just education anymore. Now it's retirement, too, because you can move some of that money into the Roth.
And later, if you do want to give it to them, all you have to do is pay the taxes.
Yep.
So
On the gains.
On the gains, yeah.
It's that simple. So I like that. Again, the first thing you should consider is the purpose of the money. In my family, I give it for education because I believe in education. I think everybody should get one if possible. Not everybody does. Doesn't work out. That's fine. But then, and now with the changes of the 529, if they don't, they can still move that into their Roth IRA once they have income, which I'm hoping they will have at some point. So I like it. But that doesn't mean you couldn't just do the UTMA or UGMA because if you want to let them buy a car when they turn 18 or something, that's the way to do it.
Maybe do all three. Do a little in one, a little in another, and a little,
Doesn't
Anyway,
have to be binary, true.
I have a question for you before we go.
Oh, gosh, yes.
No, can you set aside, I know you have copies of The Line Uncrossed, my novel.
Many.
And Financial Physics, right?
Yes.
I'm doing something on tomorrow's Q&A show. A couple of weeks ago, I was really getting low on recorded questions, the ones you speak when you go to talkingrealmoney.com using the mic button. Well, because I begged again, I got a lot of them. But Tom sent me a few written questions that hadn't yet made it to tree killing form. And I was going to use some of those and have AI voice them.
Yeah.
But I don't really need them, but I have them. So here's what I'm going to do over the next couple of weeks. At least tomorrow for sure, and maybe over the next couple of weeks. I'm going to have real human questions where you've spoken them.
Yes.
And I'm going to sneak in one where I have a different AI voice read the question.
And our job is to decide who.
I am not going to tell you which one of the 5 or 6 questions is AI. So here's the contest. The first person who goes to talkingrealmoney.com and sends me, with the contact button, the contact form, sends me the correct one. Yeah. First person who does it. And if you multiply, you can only have one entry per person, so somebody can't send 6 in.
It's Bill. No, it's Jim. It's Susan.
I got to have your email address, and I'm
I could use my wife's email.
I'm counting on you not to cheat. It's 2 dang books, folks.
That's
all you're getting.
Both books.
Both books.
Wow.
The entire Don McDonald collection.
Wait. Let me hear this right. I'm going to send them 2 books. You're sending them nothing.
Right, because you guys will pay for the postage, and I don't want to do it.
Because we got people.
We got people there. Yeah. Appella has people.
They do.
And you've got the books and the people and the mailing envelopes.
If you're asking for permission, the answer would be no. But I'll do it.
I'm not because he's going to do it. So anyway,
stop you.
That sounds cool. So tomorrow's...
I'm going to try it myself. I'm looking forward to it.
Yeah. So one of the questions is going to be spoken by AI.
You'll never be able to figure it out.
It's really hard. I'm telling you, I already recorded. I already had it done, and I went, that sounds just like the people who call.
Yeah, I think it really does. It's scary.
Kind of like the music. So ask us your questions at talkingrealmoney.com. If you want to meet with one of the Appella advisors who's... Including Tom.
Yeah, I'm looking for some conversations. Had one today. It was great. Let's get them going. I like it.
Click on Meet an Advisor, that little button there, and there's no cost, no obligation, no high-pressure sales pitch.
You push the button that says Interrupt Tom's Vacation. I'll get to it as soon as I can.
Yeah, well, And that means could be months.
I don't think so.
You're
So I think
taking
this-
another trip soon.
I think I'm going to California to drop the girl
With an
off
aching
at
in my
college,
heart?
and then I'm going to Nashville for the conference, and then I don't want to say what I'm doing in December. I'll get in trouble. So let's just...
Oh my gosh, you're going on another incredibly expensive Christmas vacation, aren't you?
Aloha, Mr. Hand.
Oh, I should use some of my vacation club points to go to Alani.
We've talked about this, but every time you look, it's like $8 million because I go at the high season.
You
So
do
need-
go at high season.
Yeah, you need to go in when is the low season in Hawaii? I don't even know when that is. July or something?
Probably now because of hurricanes.
Okay, yeah, it sounds good. Sure,
Yeah.
cheaper because you may or may not actually
Get
have
blown
a
away.
roof. Yeah, exactly.
Thanks for being there. I'm Don, that's Tom, and what are we doing? We're
Talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.